You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball, my co-host John McEwen. It's the 7th of July, 2022. In this week's episode, we're going to be discussing Currys, Moonpig, Sainsburys, Polar Capital Holdings, Persimmon, and instead of our US company of the week, we've gone with a German company, Adidas. John, shall we start with Currys?
Yes, so Currys, the FTSE 350 electronics retailer, had their full year results out today with full year revenue of £10.1 billion, which was in line with the previous year and not taking into account exchange rates. Underlying profit before tax was £31 million ahead of guidance, coming in at £186 million. However, a large proportion of this reflected an unexpected revaluation of money owed to the business, which is not likely to repeat. In the UK and Ireland business, revenue fell 3% to £5.5 billion, with like-for-like sales down 4%. These declines were mostly attributable to the fall in mobile revenue, with Carphone warehouse stores being closed at the end of the previous financial year. However, with the lifting of restrictions, store sales grew 61%, and consequently, the online share of the business fell from 65% to 45%. Compared with pre-pandemic levels, the online store sales are still 13% ahead. Underlying cash profits, EBITDA, was down 3% to £280 million. In the Nordics, revenue was up 2% to £4.1 billion. However, like-for-like sales fell 2%. Meanwhile, online sales were down 14%, but 50% up on pre-pandemic levels, accounting for 25% of total sales. Standout performers were domestic appliances and VR gaming, and EBITDA rose 1% to £264 million. In Greece, revenue was up 13% to £554 million, with like-for-like sales growing 4%. In-store sales were up 47%, offsetting the 51% decline in online sales. 2 new stores were opened in Cyprus with strong initial performances. In Greece, aircon sales were the standout performers with the European heatwave. EBITDA was up 18% to £44 million. For the year, free cash flow came in at £72 million, down from £438 million last year, with a reinvestment in stock and the benefit of the early repayment of debt last year. There was a net cash position of £44 million compared with £169 million a year earlier. Going forward, the chief executive, Alex Baldock, is warning of tougher times and was not counting on the general trading environment getting better anytime soon. He said that profits could drop between 130 and 150 million pounds this financial year because the environment is not very friendly. The group planned to freeze prices and offer a 12-month pay delay on every purchase more than £99. And Baldock went on to say, these strong results show that a vital role that technology plays in millions of people's lives, and that more and more customers are turning to Currys to help them enjoy that technology to the full. Our scale as an international market leader, our grip on costs, and our strong relationships with suppliers will allow us to manage inflationary headwinds. Consequently, we will use the expected market weakness as an opportunity to gain share and build long-term value. In terms of valuation, Currys has a market cap of £829 million and trades at just 5.5 times earnings, compared with a 10-year average of over 10. Current yields about 5.5%, and the shares have been down over 75% in the last 5 years. I mean, I don't think these results were terrible, but I think the recessionary fears and the fact that Currys is operating in a highly competitive market, which is at the difficult at the best of times, but particularly as inflation and I suppose stagflation are inevitably going to hurt some discretionary purchases. I think that there's a long way for Currys to fall, even at the current valuation. So it's not a company that I'd have liked before I suppose the wider macroeconomic picture has deteriorated, but it's certainly not one that I'd like at this point in the cycle. I'm not sure what your thoughts are, Sam, whether you've got any more positive things to say about Currys.
Similar to you, I don't think the results were that bad. It's the guidance that's the issue going forward. Obviously, the market, that's why it's so cheap, because the forward PE of 5.6, it looks very cheap, but obviously if sales are going to drop off a cliff, that's why. I thought it was interesting that I was surprised by the size of the international business. So the international business is probably like 45% of revenue. I didn't realize it was that international. I know we've covered it before, so I probably said the same thing last time, so maybe I'll remember now. But as well, the online sales in the UK business at 45%, I think that's a solid number, actually. I was surprised it was that high, just because the stores are everywhere. So I just thought, well, surely everyone's going in store. Even if the sales were, the guidance was better, I don't think I'd ever consider it. It's just too low margin. It's too competitive. I'd always feel uncomfortable holding it. But I do think this is a good year that they've had. Yeah.
So not one for the watch list.
I don't think there's anything this business could do to get on my watch list. What about you? Would it ever get on yours?
No, absolutely not. Absolutely not. I mean, I don't like it at the best of times, so I definitely don't like it now.
No.
And it's it sounds like the chief executive is he's optimistic, but he's also sticking in the guidance some pretty bad news.
Yeah, so it's just not for me.
Moonpig.
So this is I think we covered it shortly after it IPO'd. So I think we covered one of the quarterly results or maybe the interim results. But they've come out with their full year results, and this is the first full year since the IPO. And for anyone who doesn't know Moonpig, they do the cards that you can order online, and then they'll just deliver them for you. And they've got quite a good range and some funny messages. So they have come out with the full year results, and revenue was down 17.3%, 304 million. However, it was up 75% when compared to 2020. Profit before tax was up 21.6% to 40 million and up 25.8% compared to 2020. Earnings per share were up 52.5% to 9.3p a share, and there's no 2020 figure because there were no earnings in 2020. So for the revenue growth of 75.8% on a 2-year basis, they've said that reflects significant growth in the customer base, higher customer purchase frequency, and a further investment in attached gifting. Revenue was down 17.3% year on year, reflecting annualization against periods of severe lockdown restrictions and ahead of our expectations at the beginning of the financial year. So what they're saying is they've had very, very tough comparatives, because a year ago in the comparatives, everyone was locked down, so you could only get cards sent online because all the shops were open. So we've seen no material impact on our gross margin rate from cost inflation. The net debt has reduced to 83 million, down from 115 million, with gross cash and equivalents up to 101 million from 66 million. And they've said that reflects the strong cash generative nature of the business. They delivered 39.8 million orders in the year, and that compares to 50.9 million last year and 24 million the year before. They've had the very high retention of customers, including those acquired during 2020 and 2021, with 87% of the group's total revenue derived from existing customers. And that's up from 79% in 2020 and 75% in 2021. They've highlighted success in engaging customers and encouraging them deeper into our data-driven ecosystem, which has enabled the group to extend its leadership position in the UK online cards, with market share in the calendar year for 2021 being 4.4 times larger than that of the nearest online competitor. And that's up from 2.8 times larger in 2019. I didn't realize they were that much bigger than everyone else, because I'd heard of them and I've heard of Funky Pigeon as well. I didn't. It's almost like Rightmove and Zoopla, where there's a very clear leader. They said since the year end, we've announced proposed acquisition of Buy a Gift, the UK's leading gift experience platform, which will deliver a step change in our gifting proposition. And they've said the acquisition is an attractive valuation with cash consideration of 124 million compared to unaudited 2022 EBITDA of 14 million. Is expected to drive over 20% accretion to annualized adjusted EPS from acquisition. The acquisition is on track to complete by the end of July. They grew the app to over 43% of orders, and that's up from 37% last year and 16% the year before. They've highlighted the highest ever gifting share of total revenue at 48%, which reflects further progress in their strategy to become the ultimate gifting companion. And that's up from 46% last year and 42% the year before. And they've launched a UK jewellery range. And in terms of the outlook, they said, based on the anticipated completion of the acquisition of Buy a Gift, by the end of July 22, we expect revenue for the enlarged Moonpig to be approximately 350 million. And that compares to 304 million for the year just gone. In the medium term, we continue to target mid-teens percentage underlying revenue growth for the enlarged group. Margin trends remain resilient in the near and medium term, and the proposed acquisition of Buy a Gift is expected to be margin accretive, so it'll increase the margin. In view of this, we've recently raised the group's medium-term adjusted EBITDA margin rate target to between 25 and 26%. There were a few interesting points in the slides as well. So the group gross margin, that's 53%, and that's up from 51% last year and 49% the year before. So I think although the revenues dropped because it's up against such comparatives, a lot of the underlying figures in terms of the way the business is doing, it seems like the business is getting better. They delivered 80% operating cash conversion during the year. Their market share went from 60% in 2019 to 68% in 2021. And the number 2 operator is now at 15%, and that must be Funky Pigeon, I'd have thought.
Yeah.
So I had no idea that was such a huge disparity. They also, I didn't realize as well, they're the top dog in the Netherlands market as well. So they've got a 67% market share in the Netherlands from Greets, and the number 2 operator is 21%, and number 3 is 12%. So in both markets, they're just dominant. And they also highlighted that they're expanding their capacity with 2 new distribution facilities, one in the UK and one in the Netherlands. In terms of the valuation, the business trades at a PE of 17.35. It's not paying a dividend currently. I actually was surprised by this. I sort of went in, this is the first time I've had a proper look at it, apart from I think we briefly looked at it shortly after the IPO. But I went in expecting a commoditized business, and this does not look like a commoditized business. It's increasing the margins, it's increasing the market share. I know revenue is down, but it's against very tough comparatives, and they're expecting to grow double digits ongoing. I think the gifting's very good. It makes sense that obviously the card might be a low ticket item, but if someone attaches a gift or jewelry or something, I think that's good. And as that dominant market share, I don't think the others can chip away at it. And the reason I don't is I use Funky Pigeon myself, but once you start using it, it gives you reminders for birthdays and stuff. So it's really useful because it's got everyone's dates in there, and that's really good because it gets you repeat buying. But also, I'm not going to move to Moonpig because it's basically, although it might be commoditized in the sense it's the same product, I'm not going to move over because I'd have to input all the dates again, some of which I may not remember. So I actually think it's quite a sticky product. So if they're that dominant with, what was the market share? I'll just get it back up again. 68% market share. I don't see that being chipped away at. So I was actually surprisingly impressed by this business. John, what are your thoughts on the results in the business?
Yeah, I mean, I think covering it for the second time, I actually quite like it. And I hadn't, like you, I hadn't appreciated I suppose the market share dominance, and then potentially adding that extra business there, and I suppose being able to grow it from there and increase the margins further with higher ticket items too. I think that's a clear potential for the business. I actually quite like it. What are we talking about valuation wise?
17 times earnings. I don't think it's unreasonable.
No, I think that's
good enough for the watchers.
Yeah, I think it is actually. Yeah,
I was pleasantly surprised by this. I expected it to be very commoditized. For me, it's not so much the growth, because it's the market you'd expect to be growing. It's how dominant it is, and also how sticky I think it is. The fact that the gross margin's going up and stuff, everything's moving in the right direction. If you can look past the revenue drop this year, which I think is for a very good reason.
Yeah. And it's 75% ahead still, if you look at it compared to 2020. So
and the share price has actually taken a hammering as well. So in the last year, it's down from 439p to 211p.
Yeah.
So shall we move on to Sainsbury's?
Yeah, okay. So Sainsbury's, one of the UK's big four grocers, had their first quarter trading statement out this week, with like-for-like sales, excluding fuel, down 4% in the first quarter. This was reflective of a drop in grocery sales up against tricky comparators from lockdown 2021. The grocery sales were down a total of 2.4%, however, remained 8.7% ahead of 2019 levels and increased value market share by delaying price increases. Sainsbury's have said that they plan to invest £500 million over the next 2 years to keep the prices low. The quarter also benefited from the Jubilee week, which boosted sales, particularly in the Taste the Difference, so their sort of premium range, which were up 12%, along with improved alcohol sales. In general merchandise, sales fell 11.2%, with declines in Argos, both standalone and integrated stores. And the group closed a further 6 standalone Argos stores and opened 5 integrated units, taking the total to 405. In clothing, sales were down 10.1%, and that was partly due to its essential store status and some of its competitors being closed in the comparative period. The group note that sales are 3.9% ahead of 2019 levels, with a boost from the return of holiday wear. The group also commented that their financial services division is benefiting from growth in unsecured lending and travel money volumes recovering. The group continues to expect full-year underlying profit before tax to be between £630 and £690 million. And Simon Roberts, the chief executive, said, "Our customers are watching every penny and every pound, and expects the pressure on household budgets will only intensify over the remainder of the year." And therefore they're keeping that value proposition and investing heavily in that. In terms of valuation, Sainsbury's has a market cap of just over £5 billion and trades at 8.45 times earnings and currently yields nearly 6%. And we've talked about the supermarkets a lot on the show before, and I think the conclusion that I certainly still have is that Tesco's, it's the market leader, it's got the best margins, it's got the best supply chain, but most integrated supply chain. Sainsbury's margins are lower at 3.2%, and it doesn't offer that premium proposition that M&S offers, nor does it offer the sort of the value quality mix of Tesco's either, probably reflected in the price. And I suppose something to be said about Sainsbury's is I think its management are doing a good job. It is being turned around, and possibly by the takeovers of by private equity of both Asda and Morrison's, it's perhaps weakened the competition a little bit. So perhaps it's easing things on Sainsbury's from that perspective a little bit compared with a few years ago, especially when the supermarket price wars were on. It wouldn't be one for me. I own Tesco's, and I sort of continue to choose Tesco's and just pay a little bit more for what I think is a better business. Sam, your thoughts?
I'd also pay up for Tesco's. Yeah, I mean, this isn't good. They're not in a good position. If we do go into a recession, or if we're already in one, which we may well be, they're going to struggle. They can't. They're in a position really where they can't, as we've talked about before, they can't really drop. They can't increase the prices with costs because people just go to Aldi and Lidl. It's the same strategy Tesco's had to adopt. It's the same strategy Asda and Morrison's will have to adopt. But as I don't know if this are they the smallest of the four, or definitely third or fourth. But either way,
yeah, I think third.
Okay, well they're in the weaker position because at least Tesco has more. Well, it's got more pulling power, hasn't it? Looks like Tesco also came out with a trading statement last month, and they warned that their UK like-for-like sales had dropped 1.5% year over year, whereas Sainsbury's down 4% excluding fuel. I don't know if the Tesco figures include fuel or not. You'd think not, because fuel is going to be up so much, but I think Tesco said in their statement that they've gained market share from the other big four chains, so that's also not great for Sainsbury's. So it looks like Tesco's at a P of about 12. Sainsburys is cheaper at 10, but I'd definitely pay up for Tesco. I mean, for that small of a difference, I'd pay up for the better business. So I agree with you. It's a long-winded way of saying it.
Okay, fine. On to our next company, Polar Capital Holdings.
Yes, it's a first. It's a debut on the show for Polar Capital Holdings, and it's snuck in through the back door as well. We were going to do Biffa, but Biffa delayed their results because the auditors asked for more time, which is never a great sign, actually. But anyway, we may get to the Biffa results when they are eventually released. But instead, we've got Polar Capital Holdings, and they are a fund management company. We've looked at several competitors on the show. So they've come out with their full year results, and profit before tax fell 18% to 62.1 million. There's an increase in operating costs more than offset a 7.6% increase in total revenue to 225.7 million. Core operating profit, which measures management fees less operating costs, rose 35% to 69.4 million. But performance fees profits fell 78.9% due to last year's exceptionally strong figures, or this year's exceptionally poor figures, I guess, depending on how you measure it. For the full year, assets under management had risen 6% to 22.1 billion, with 31% attributable to net inflows and the remaining 867 million down to investment performance. Average assets under management was up 37% to 22.8 billion, and that reflected a peak of 25 billion in early Jan, followed by a decline as markets sold off in the 3 months from March. It's worth noting that they have their expertise as fund managers is technology and healthcare. So technology funds are 42% of the assets under administration, and healthcare funds are another 17%. So that's nearly 60% of the business. If you go in a little bit further, assets under management for open-ended funds, which make up 75% of the total, saw no change, while investment trusts, which is 20%, rose slightly. Segregated mandates, funds run exclusively for a particular client, saw assets under management rise 745 million to make up 5% of the group's total. The group continued its pivot from technology with 42% of assets under management, and that's down from 49% last year. Whether or not that's actually because of a decrease in the value of tech stocks is maybe to be seen. And 1.3 billion in net outflows from technology were more than offset by net inflows to sustainable emerging markets, healthcare, alternative convertible bond funds, European opportunities, and newly launched sustainable thematic equities. The decline in fund performance versus last year meant performance rewards to staff more than halved. However, this was more than offset by rising costs as new teams were added and management fees rose, given the increase in assets under management. Lower profits, together with the timing of dividend payments, meant the group's cash position fell from 136 million to 121 million. It's interesting that performance fee profits fell 78%, but they just said that performance rewards more than halved. So I don't know if they've fallen exactly in line. In terms of the valuation, the company trades at a PE of 10.7. That compares to a 10-year average of 13.5. And the prospective yield for the next 12 months is 8.6%. However, they're currently paying dividends which equal 88% of net profit, and that's higher than management's target of 55 and 85%. If we continue to see the sell-off that we're seeing in stocks, I would not expect the profits to be as high over the next few years. So I would expect to see that dividend come down. My thoughts are, I'd give them a pass in that, everything's down at the minute, so you're not going to expect good results. But having covered quite a few competitors, I wouldn't say there's anything special in here that makes me think I need to take a look at this. John, what are your thoughts on the results in the business?
Yeah, I think along the similar lines, I was going to ask you, when you looked at it, what are the typical sizes of the companies that they do invest in within these funds? Because obviously we had Neil Woodford a few years ago investing, I suppose, science, tech, biotech, and having some sort of illiquid companies in these type of sort of open-ended funds, and whether that's something that would pose a risk or could potentially pose a risk if shareholders were to lose confidence in, or investors lose confidence in some of their funds, if there was an exodus.
Let's have a look. So they've got 29 funds on the website. I'll try UK Value Opportunities Fund, where it tells the holdings. I mean, there's some companies I don't recognize, but in the top 10 positions in the UK one, it's got M&S, which I guess probably makes sense to have that in the value fund actually, because that looked quite decent last time we looked at it. 3i Group, Howden Joinery. I don't know some of the others, but that doesn't necessarily. Oh wait, here we go. Market cap exposure. So 21.9% of the market caps of the companies listed are over 4 billion, 52% 600 million to 4 billion, and 22% under 600 million. So I'd say that one looks pretty liquid.
Yeah.
And that's a UK one where it's probably going to be smaller funds. So if we pick another one, let's try the Global Technology Fund. Yeah, Global Technology Fund's huge. They've got 60% of over 50 billion market cap, 21% 10 to 50, 18% 1 to 10 billion, and 0% less than 1 billion. So they're going to be pretty liquid.
Okay, fine.
So I think it looks like, I mean, they could have a fund that's for that, but there's nothing in there to suggest they're being a bit naughty and doing a Neil Woodford and listing unlisted stocks.
Okay.
It looks pretty liquid to me.
Okay, cleared that one up then.
Well, we could go and check all of the funds, all 29 of them or whatever it is. But we've done a sample too. We're happy with that.
Yeah. Okay.
What do you think of the business then?
It's interesting. I'm not immediately drawn to it. And I suppose at the moment, they're definitely, as you highlighted, they're going to be facing very difficult times. I suppose that is reflected in the price. It's cheaper than it is normally. But yeah, not something that I'm immediately drawn to be honest.
Should we move on to something that you are immediately drawn to, a house builder?
Well, yeah. So Persimmon, the FTSE 100 listed house builder based in York, had a trading statement out today with first year revenue falling 8.2% to £1.69 billion, with supply chain issues, labour shortages and planning delays. A 4% increase in average sales price did help offset the rising building costs, however. In terms of average private weekly sales rate per site, this was 1% ahead of last year, and the group is currently 75% forward sold for the full year, with forward sales rising by £1.87 billion from £1.82 billion. The group delivered a total of 6,652 new homes, with an average selling price of around £245,600 in the first half. This has included a 4% price increase, but a 10% volume decline with material and labour shortage alongside the planning delays. The volume decline is likely to lead to operating margins being squeezed, and the group has highlighted a further 1,500 plots to come onto the market in the next 5 years, but is concerned with ongoing planning delays from the pandemic. The group currently has £780 million in cash, with £125 million in land creditors. They expect to deliver between 14,500 and 15,000 completions this year, but are not optimistic about the supply chain issues and planning delays resolving anytime soon. They're expecting profits at the half year to be slightly above expectations. In terms of valuation, Persimmon has a market cap of just under £5.6 billion and trades at just 7.5 times earnings, with a prospective yield of over 12%. I still like the house builders, although I appreciate that with interest rates rising and stagflation hitting wages, they are, and as we're seeing, one of the first sectors to be hit. I've held Persimmon in the past. I've also had Taylor Wimpey. I currently have Redrow as my favourite one in the sector, and the news and I suppose the sort of the wider economic picture isn't putting me off. I think there are the fundamentals with the supply demand imbalance and the house builders, the big listed house builders being the solution to that. I'm happy to hold them, but I think you'd have to sort of be prepared, and you could even take a sort of an indexing approach, because things, as we're seeing, are quite volatile with them at the moment. But I think they will win out in the end, but it's just going to be a bumpy ride in the meantime. And I suppose that dividend, I certainly wouldn't be buying it for the dividend, because that's obviously not guaranteed, and at such a high rate, you might expect that the market is pricing in that recession, and that dividend could easily disappear. Sam, what are your thoughts on Persimmon and the house builders in general at the moment?
I think this is fine. I mean, it's not fantastic figures. It's not nice when they're down on last year, but when the problem is they just can't build them quick enough, as long as it's not something at their end, which it isn't, we're not new to supply chain problems in the current economics environment. I think it's fine. It's very much a temporary issue. Like you say, we've got an undersupply of housing. What I think is really interesting about this statement is there's nothing in the statement about having problems selling the houses. And we've seen all this talk about interest rates going up and is there going to be a property crash? That's not feeding through onto this. The problem is that they can't build the houses, which is still a problem. But when they're selling all the houses they build and they're passing on the price increases from the cost inflation, and we've got an undersupply of housing, and it's at a P ratio of 7.5 with a yield of 12%. I know they've got a policy of paying excess cash to shareholders, so if the sales are down, the dividend will come down a bit. But I don't think there's anything then there that would concern me.
So if you were buying shares, you might not actually see that. You might actually not feel that dividend is going to be suffering.
Well, if they can't build them quick enough, they're not going to sell them, so you might get a lower dividend. But in 2 or 3 years, hopefully we won't still be having supply chain problems. They'll probably be back at 2021 levels or even higher. So I think you'll get back to the 12% dividend on a cost basis. Yeah. That's probably quite a nice place to be in 2 or 3 years. I think when we've got such an undersupply of housing, I think something would have to go catastrophically wrong. I mean, if interest rates go to 10% and that kills demand, maybe that has an impact, but you're looking at a business, aren't you? You're not trying to make a macro position, but you're not trying to make a macro position. And the house builders, I mean, most of the FTSE listed house builders, they're good businesses.
Yeah. And they're much healthier than they were 10, 12 years ago.
Yeah, and they've got decent land banks as well. So if they needed to preserve cash, they could just chip away at the land bank. So they can cut the dividend. There's a lot of levers they can pull if they start having problems. But if the only problem is they can't build stuff quick enough, it's not ideal, but it's not a disaster.
And valuation-wise, what do you think?
I like it. I think part of the reason the PE is lower than normal is because the profits could and probably will come down. But I take the view that this is very much a temporary problem. If you look at it on a cost basis, in a few years' time, I would expect the profits to be back up at 2021 levels. And on a cost basis, you'd have got it very, very cheap when it's back at that. So it might, maybe it's a 7.5 times earnings valuation now, and it's actually going to drop. So you're going to get more like 10 or 11. But in 2021, I think it'll be back at that PE of 7.5 if the price doesn't move. So I think now is probably a good time to buy. And the share price, they've all been hammered on the share price, haven't they?
Yeah, they're about 30% down year to date.
Which I think is decent for what was already a cheap business anyway.
Yeah, no, absolutely.
No, I like it.
Okay, one for the watch list.
I do like the house builders. I don't know if I'd buy one, but I do like them. And I can see why certainly someone who's their portfolio is more geared towards income. If I was building an income portfolio with UK listed stocks, there would be at least one house builder in there and possibly 2 or 3.
Okay, fine. So our German company of the week.
A new segment. So yeah, we normally do US, but I wanted to cover Adidas for a while and I've just never got round to it. So I decided we're doing it this week. And it's going to be our German company of the week. We'll probably be back to US next week though. So Adidas, probably don't need an introduction, but they make shoes and other sportswear. You don't know who they are, and probably been living under a rock, haven't you? So they actually, because I just wanted to cover the company, because we've never covered it before, the results, it's the Q1 results, but they came out 2 months ago. So a couple of months old now, but I wanted to look at them anyway. So Q1 results, and it includes currency neutral sales were down 3% as supply constraints reduced top line by 400 million euros. And all these figures will be in euros. Western markets continue to show strong momentum with combined currency neutral sales growing 13% and across North America, 9% in Europe, Middle East and Africa, and 38% in Latin America. Gross margin down to 49.9%, and that's 1.9 percentage points down, driven by significantly higher supply chain costs. Operating margin of 8.2%, reflecting additional investments into brand, direct to consumer and digital. Net income from continuing operations, 310 million. Full year 2022 outlook for revenue and net income confirmed at the lower end of guidance due to the impact of COVID-19 related lockdowns in Greater China. In light of the supply shortages, the company continued to prioritize its own D2C direct-to-consumer channel in the quarter. As a result, direct-to-consumer revenue increased 1% versus the prior year, reflecting a 33% increase compared to 2020, while Adidas e-commerce revenues experienced a double-digit increase in the share of full-price sales. Revenues in the company's own digital channel increased 2% during the quarter, reflecting the exceptionally high growth in the prior year. Compared to the 2020 level, e-commerce revenues grew 50% in the quarter. And there were a few interesting points in the slides. So the first one, they've given the sales growth by segment. So North America was up 13% and the operating margin was 18.3%. Europe, Middle East, Africa, operating margin 22% and growth was up 9%. Latin America grew 38% with an operating margin of 19.8%. And this is where the losses came in. So Greater China was down 35% with operating margin of 22.5%, and Asia Pacific was down 16%. So that's why they've shrunk. If it wasn't for that, they would have grown. There's not really anything they can do about that either if everything's locked down again. They also highlighted that the direct consumer share of sales is 36%, and that's up 2 percentage points from 2021 and 3 from 2020. And for the full year 2022 outlook, they confirmed they're expecting revenue to increase between 11 and 13%. The gross margin, they're expecting that to come in at 50.7%, operating margin of 9.4%, and that's up from 8.2% in the current quarter anyway. And they're expecting net income of between 1.8 and 1.9 billion. And that's based on the assumptions that there'll be a steady recovery from the negative impact of the geopolitical situation, no lockdowns in major cities as of Q3, and sequential improvements from strong double-digit traffic decline in Q2. I don't know if I've told this on the show before, but one of my favorite facts is that Adidas is named Adidas because the German founder was called Adolf Dassler and his nickname was Adi. So people called him Adi Dassler and Adidas for short. So that's where it came from. And he set it up with his brother, but I think they fell out. So his brother went off and founded Puma.
Oh, wow. I didn't know that. That's a very interesting factoid. Yeah. Or two.
Yeah, double whammy. So in terms of the valuation, the business trades at a P/E ratio of 26.16, has a market cap of 32 billion and a forward dividend yield of 2%. And for comparison, Nike trades at a PE of 28, has a market cap of 168 billion, and that's dollars. So Nike's about 5 times bigger and a dividend yield of 1.17%. I thought these were decent results. It seems like a good business if it's going to plug away at sales growth, double digits for a business of that size. It's a very, very well-known brand. So I think to be a fifth the size of Nike, I think there probably is quite a bit of room to take some market share when it is such a strong second. I think it's a good business. I don't know how I feel about a PE ratio of 26, but I guess if it's going to keep plugging away at 12% growth a year, maybe you can justify it. But for me, it's a very, very good business, but probably a little bit pricey for me. John, what are your thoughts?
Yeah, I mean, I like the brand. I think it's very good business too. It's encouraging, like Nike, that they're continuing with a decent proportion and increasing the direct to consumer, and it's got good margins. I mean, I do really like it. But I suppose it is just the price, and I guess it's a question of paying up for that quality. How has the share price been doing? Has it pulled back at all, or is it?
It's done. So in the past year, it's almost been cut in half actually. So it was at 311. Really? Yeah. I don't know whether this is 311 euros a share. It's now at 169.
So it is cheaper than it was, but it's it's.
I mean, it's actually lower than it was 5 years ago. I see how the business has done in that 5 years. Yeah, see, revenue's not really moved that much. How have earnings done? And it's not really. Yeah, so they might be growing 10 to 12% this year. It looks like historically they haven't done that. Yeah, it probably could be doing quite a bit better then, because I wonder what Nike's done. Let's have a look at Nike's revenues in the last 5 years. Yeah, see, Nike's, I mean, they're not amazing, but the revenue's grown from 39 billion to 46, and earnings per share's grown in that time as well. With Adidas being a fifth of the size, I don't think they have any excuse for not growing revenues, to be honest. I'd need to know a bit more about if there's anything that's going to actually kickstart the growth. I'll also get that James on, that quality compound. He talked about Adidas last time he was on the show, and he made quite a good bull case for it. So he could possibly tell you why. So it's in his portfolio, so he could probably explain better why he thinks they'll start doing better. But it's probably a business. I'd almost compare it to a bit of a Unilever. It's probably better managed.
Yeah, certainly at the moment. Yeah, no, I think it's one for my watch list anyway.
Of the 6 companies we talked about this week, Currys, Moonpig, Sainsburys, Polar Capital Holdings, Persimmon and Adidas. If you had to buy one, which one would it be?
I think I would be going for Persimmon, and it would be for the reasons I outlined earlier. I'll be back in the UK house building sector in the long term, and I think it's cheaper than it has been for a while.
I thought I might have been able to tempt you with Moonpig, actually.
No, the other two, the second and third, would be Moonpig and Adidas or Adidas. They'd be my others.
I'd go with Moonpig as mine. I just thought,
it's an interesting business. It's very
and quite reasonably priced for the growth it's probably still got in it. Right, so I think that's everything then.
Thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.